James Abate, one stock you like over at Center Funds is P&G. Now, Procter Gamble's down almost 20% so far this year. It's turned up a little bit lately, so is the worst over?
Yes, we believe the worst is over for Procter Gamble. Now, the stock has been down because it's missed 4 consecutive earnings per share targets or estimates by Wall Street. Now, what are we noticing in the most recent quarter, however? We've seen that some of the cost restructuring efforts that they've taken, namely to improve margins and, more importantly, increased asset efficiency and inventory turnover, has started to basically boost the return on assets and return on capital for the company. So here's a company trading at 19 times earnings with a 3.5% dividend yield, where we're seeing a positive inflection in operating performance. So that's definitely a name that we look at as a turnaround in a non-defense or a defensive non-cyclical area of the market, which we prefer at this time.
All right, well, you're also a fan of General Mills. This stock's up around 6% this year, pays a nice 3% dividend. And the good news, according to the last call, is that people are eating more cereal again. Their cereal business has stabilized.
Well, General Mills is taking steps both to restructure its business, sell off non-performing assets like Green Giant, but also innovating. Gluten-free Cheerios is one example of that. Now, why are we bullish on General Mills? Here's a company that's taking efforts to basically improve its profitability. We've seen gross margins improve by 3 percentage points in the most recent quarter, year over year. So here's a company, again, that has defensive characteristics, improving margins in an overall market where margin improvement is a very scarce commodity. And once again, a company that's trading at 19 times earnings with a 3% dividend yield. So that's a name that we're very bullish on in the Center American Select Equity Fund.
And Kimberly-Clark also pays around 3% for their dividend. It's another stock you like. It's down around 1% for the year. One would think will be doing better because commodity prices have come down.
That's right, and Kimberly-Clark is another company in this 19 times 3% club that we've just talked about. 19 times earnings, more than the 3% dividend yield. So it's obviously tough to get excited about diapers and toilet paper, but in an environment where revenue growth is scarce, Kimberly-Clark is able to put up low single-digit revenue growth, improving its margins. And as you touched upon, if you look at their commodity cost index, it's down 30% over the past 1 year. And that is going to provide a further tailwind for the company to continue to incrementally improve its profit margins and returns on capital.
All right, and then finally, you are a fan of Target. This stock was up 4% for the year, but because of Walmart's sales forecast that they're going to be cutting, Target came down as well. It's now flat for the year, down 4% today. So do you stick with Target in light of the Walmart news?
Absolutely, because what you've seen is the entire consumer discretionary sector get hit today because of the news out of Walmart that sales are going to be down. But one of the more important aspects out of Walmart's news was the fact that their costs, particularly labor costs, are going up. Now, Target represents a good opportunity because they're taking unique steps to restructure their business. They've sold off their Canadian operations, their in-house pharmaceutical operations here in the United States, and more importantly, their digital presence is actually showing phenomenal growth. It's up 30% year over year. And the most important aspect with Target is that they're able to take an opportunity here to perhaps distinguish themselves from Walmart, which is much more of a general merchandiser, and again, get that Target label that one used to give it the cachet that gave it a premium multiple.
I remember Target. Thanks a lot, James.
Thank you, Greg. Good to see you again.
And thank you for watching The Street.